Before we start, a quick disclaimer. I am not a financial advisor, and this video is for education and entertainment only. Nothing here is investment, tax, or legal advice, and nothing here is a recommendation to buy or sell any security. Investing carries risk, including the possible loss of your capital. Past performance is no guarantee of future results. I may hold some of the assets discussed. Always do your own research and consult a licensed professional before making any decision. Here is a question almost every growth investor runs into. You want exposure to technology and the broad market through low-cost index funds, but the moment you look closer, the choices multiply. Do you buy the whole semiconductor sector, just the S&P 500 information technology slice, the Nasdaq 100, or the entire global market? Do you tilt toward momentum? And what about leverage? In this video, we line up 7 exchange-traded funds side by side on a total return basis from 2020 through 2025. And we look at what actually drove returns, what the risk really was, and how the picture changes depending on whether you invest from the United States or from Europe. First, an important structural point that trips up a lot of people. If you invest from the United States, you can usually buy the popular American listed funds directly, things like the Vanguard Information Technology Fund, the Invesco Nasdaq 100 Trust, or an S&P 500 Momentum Fund. But if you invest from Europe, most of those US domiciled funds are blocked. Under European rules, the PRI-IPS regulation, a fund has to publish a specific disclosure document, and most US issuers simply do not bother. So, European investors buy the UCITS equivalents instead, the ones listed in London with the .L ending. They track the same indices, but the wrapper is different. Throughout this video, the solid bars are the UCITS funds a European investor can actually buy, and the hatched bars are the US references, shown only for comparison. Let us start with the headline number, the 5-year compound annual growth rate from 2021 through 2025, total return with dividends reinvested. The leveraged Nasdaq fund sits on top at around 34% a year, but hold that thought because that number hides a lot of pain. Below it, the global semiconductor fund compounded at roughly 28%. Then the US technology references. Among the plain unleveraged funds a European can buy, the S&P 500 IT sector fund leads at about 19%, the Nasdaq 100 around 15, the broad S&P 500 close to 14, and the all-world fund just over 12. The pattern is intuitive. The more concentrated the bet on technology, the higher the return over this particular window. But concentration cuts both ways, and the next chart is where that becomes obvious. Here is the same set of funds, but now showing each individual year from 2020 to 2025. Notice how tightly the broad funds, the S&P 500 and the World Index, hug a calmer path while the semiconductor and leveraged funds swing violently. In 2020 and 2021, everything went up. Then came 2022, the year that separates a smooth compounder from a white-knuckle ride. After that, 2023 was a furious recovery, and 2024 and 2025 settled into more normal-looking gains. The single most important lesson in this chart is that the average return you saw on the previous slide was never actually experienced in any single year. You lived through the swings to earn it. This is the chart that matters most, and it is the one most people skip. It shows how far each fund fell in 2022, the worst year of the period. The broad S&P 500 and world funds lost somewhere around 18%. Painful, but survivable. The concentrated technology and semiconductor funds dropped roughly 30%, and the 3 times leveraged Nasdaq fund collapsed by nearly 80%. Think about what that means. A fund that fell 80% has to rise 400% just to get back to where it started. That is the hidden cost behind that 34% average we saw earlier. Leverage does not just multiply your gains, it multiplies the depth of the hole you have to climb out of, and it introduces something called volatility decay, where a daily reset leveraged fund loses ground in choppy markets even when the underlying index goes nowhere. Let us make this concrete. Imagine putting 100 units into each of the unleveraged UCITS funds at the start of 2020 and simply holding through the end of 2025, letting each year compound on the last. The semiconductor fund ends up the clear winner in absolute terms, followed by the IT sector fund. The Nasdaq 100 lands in the middle, and the broad S&P 500 and world funds finish lower, but with a noticeably smoother line getting there. The gap between the lines is the reward for concentration. The smoothness of each line is the price you paid in stress. There is no free lunch here, just different trade-offs between how much you might make and how much turbulence you can tolerate without selling at the bottom. Now, cost. Every fund charges an annual fee, the total expense ratio. On this chart, the horizontal axis is that fee, and the vertical axis is the 5-year return. A few things stand out. The broad S&P 500 fund is the cheapest of the group at well under 0.1%. The sector and thematic funds charge more. The semiconductor fund around 0.33%. The leveraged fund, the most expensive by far, at 0.75% per year on top of its internal borrowing costs. The point is not that cheap always wins. It is that you should know what you are paying and be sure the strategy justifies it. A higher fee on a fund that simply tracks the same index as a cheaper one is just a drag on your return with nothing to show for it. A quick word on the momentum funds because they are popular and often misunderstood. A momentum strategy tilts toward whatever has been rising recently and rotates out of laggards. Over this period, the US momentum reference posted strong numbers, helped by a couple of standout years. The World Momentum UCITS fund, however, was more muted, landing near the bottom of our group at around 11% a year. Momentum can shine in trending markets and then whipsaw badly when leadership suddenly rotates, as it did in late 2022. It is a factor strategy, not a magic wand, and its results depend heavily on the exact index methodology and how often it rebalances. Here is a subtle risk that catches many investors who own several of these at once. They overlap. The semiconductor fund, the IT sector fund, and the Nasdaq 100 all lean heavily on the same handful of large technology names. If you hold all three thinking you are diversified, you may actually be making one very large concentrated bet on a few companies wearing three different costumes. The broad S&P 500 and world funds already contain those same companies too, just at smaller weights. So before stacking thematic funds on top of a broad core, it is worth looking through to the actual underlying holdings and asking how concentrated your true exposure really is. So how might someone think about all this without anyone telling them what to buy? One reasonable mental model is layers. A broad, cheap core, something like an all-world or S&P 500 fund, does the heavy lifting with the smoothest ride. Around that, an investor with a higher risk appetite and a long horizon might add a measured tilt toward technology or semiconductors, accepting bigger drawdowns in exchange for higher potential growth. Leverage, if it is used at all, belongs in a tiny, clearly defined slice that you can afford to watch fall 80% without it changing your life. The right mix is personal. It depends on your time horizon, your tolerance for watching your account drop, and whether you will actually stay invested when it does. To wrap up, over 2020 to 2025, more concentration in technology meant more return and far more pain in the down years. The broad funds gave up some upside for a much calmer path. Leverage produced the biggest headline number and the most brutal drawdown by a wide margin. And if you invest from Europe, the UCITS versions are the practical way to get this exposure, since most US listed funds are off the table. None of this tells you what to own. That depends entirely on you. If you found this useful, consider subscribing and remember the disclaimer at the start. Do your own research and take care of your downside first. Thanks for watching.